You wake up, reach for your phone, and before your feet even touch the floor, you already feel it. That weird drop in your stomach. You open your investing app. Red. Not just a little bit red. The kind of red that makes you blink twice as if the numbers might somehow correct themselves if you stare hard enough. You check another app. Also red. You open the group chat. One person says, "I sold everything." Another says, "Bro, this is just the beginning." Someone else is trying to act calm, posting things like, "Buy the dip," but you can tell everybody is low-key panicking. And now you are just sitting there, half awake, staring at your screen, wondering one very dangerous question. Should you do something right now? Because that is what a market crash does. It does not just hit your portfolio. It hits your brain. It hits your confidence. It makes even long-term investors suddenly feel very short-term. And this is the part nobody really explains properly. When the market crashes, you are not just watching numbers fall. You are watching your own emotions get tested in real time. The stock you felt good about last month now feels like a mistake. The ETF you said you would hold for years suddenly feels scary. The plan you were so confident in starts looking shaky. And even if you told yourself you were a long-term investor, your brain starts whispering things like, maybe I should just sell now and buy back later. Maybe this is different. Maybe this gets way worse. And honestly, that reaction is normal, because crashes feel personal. A crash makes you feel like something has gone wrong, not just with the market, but with your decisions. But here is the catch. In most crashes, the biggest damage does not come only from the market falling. A lot of the damage comes from what people do during the fall. They panic sell. They throw all their cash in too early. They buy random things just because prices look cheaper. They act without a plan. And later, when the dust settles, they realize they did not lose because they were dumb. They lost because they were emotional. So in this video, I want to walk you through what you should actually focus on during a rare market crash. Not hype, not fake guru nonsense, not bro just buy the dip with zero context. A real-life practical framework. Something simple, something calm, something you can actually follow. Because when the market gets ugly, you do not need more noise. You need a process. A market crash is not just about prices going down. It is about uncertainty showing up all at once. It is when the headlines get louder. It is when social media suddenly becomes full of fear. It is when everybody starts sounding like an expert, but nobody actually knows what happens next. And that is why crashes mess with people so badly. Because human beings hate uncertainty. If the market falls and you know exactly when it will recover, that is one thing. But that is not how crashes work. A crash can drop fast, bounce, fall again, get worse, scare people more, and drag on longer than anyone expects. That is why so many people crack emotionally, not because they are weak, but because nobody likes feeling powerless. And if you have never lived through a proper market crash before, it can genuinely feel like the system is breaking. You start imagining worst-case scenarios. You start questioning every decision. You start wondering whether you should stop, wait, sell, hide, or just pretend your app no longer exists. And this is not new. Think about the big scary periods people always remember. Think about 2008. Think about 2020. Different causes, different headlines, different stories. But the emotional pattern is always kind of the same. Fear rises. People rush to react. And later, many realize they made the worst decisions at the worst possible time. What people often miss is that crashes do not just expose bad companies. They expose bad habits, bad planning, bad risk management, bad expectations. A crash reveals whether your strategy was actually a strategy, or whether you were just feeling smart in a bull market. Because let us be honest, when everything is going up, almost everybody looks clever. But when the market turns ugly, that is when the truth shows up. That is when discipline matters. That is when diversification matters. That is when cash matters. That is when emotional control matters. The first thing you should do in a market crash has nothing to do with charts, and honestly, this is where a lot of people mess up. Before you think about buying anything, before you think about taking advantage of cheaper prices, before you think about deploying capital, like some finance bro on the internet, you need to check your real life first, because if your real life is unstable, the market crash is not your sale season. It is your warning sign. Ask yourself something simple. If something goes wrong next month, are you okay? Do you have emergency cash? Can you cover your bills? Can you handle a car repair, medical issue, or sudden expense without being forced to sell your investments? Because that is the real danger during a crash. Not just that your portfolio is down, but that life hits you at the same time, and now you are forced to sell at the worst moment because you needed the money. That is why emergency fund comes first, not later, not after you buy the dip. First, if you do not have emergency savings, then your first mission during a crash might not be to invest more. Your first mission might be to stabilize your own finances, and that is okay. Seriously. Too many people feel embarrassed by that. They think if they are not aggressively buying during a crash, they are missing out. No. If your bills are shaky, your job feels uncertain, your debt is ugly, and you have no breathing room, then protecting yourself is not weakness. It is intelligence. A market crash is not the time to play hero with rent money. It is not the time to act rich with borrowed money. It is not the time to gamble with cash you might need next week. So step one is boring, but very real. Protect your real life first. Build or preserve your emergency fund. Make sure you can survive stress. Because when your foundation is strong, you think more clearly. And when your foundation is weak, every red day feels like a personal attack. That is why this matters. Before you think like an investor, think like an adult. Bills first. Emergency buffer first. Stability first. Opportunity comes after survival, always. Now let us say your emergency fund is fine. Your bills are covered. You have some ready money. Good. This is where a lot of people make their next mistake. They take all the money they have and throw it into the market in one shot. Because the market is down and they think, this is it, this is the moment. Maybe. Maybe not. And that is exactly the issue. Nobody knows the exact bottom. Not you, not me, not the guy online posting dramatic thumbnails and pretending he called everything perfectly. A market crash can fall 10%, then 20%, then 30%, and still go lower. That is why buying in stages makes sense. It is not flashy, but it is practical. Buying in stages just means you split your money into parts instead of going all in immediately. For example, let us say you have 1,000 ringgit of ready money. Instead of dropping the whole 1,000 ringgit in today, maybe you split it into 4 pieces. 250 ringgit now, 250 ringgit later if the market drops more, 250 ringgit maybe next week or next month, and the last 250 ringgit stays flexible in case prices get even better. That is it. Nothing genius, nothing sexy, just process, and this matters because buying in stages reduces pressure. You do not need to be perfect. You do not need to catch the exact bottom. You do not need to impress anybody. You just need to stay consistent. It also helps emotionally, because if you put everything in today and the market drops harder tomorrow, you may start panicking. You may feel stupid. You may abandon the plan. But when you buy in stages, you still have money left. That changes the psychology completely. You feel less trapped, less reactive, less dramatic. And even if your amount is small, this still works. If you only have 200 ringgit, fine. Split it into 50 ringgit at a time. If you only have 100 ringgit, maybe do 25 ringgit at a time. The amount matters less than the habit. The principle is simple. Move slowly enough that your emotions do not outrun your brain. Because during a crash, the biggest enemy is often not the market. It is the part of you that wants certainty right now. And buying in stages respects uncertainty. It says, I do not need to be perfect. I just need to be disciplined. That is a much healthier mindset. Now this one is huge, and honestly, it should probably be repeated more than once because so many people ignore it until pain teaches them the lesson. Diversification matters, a lot, especially during crashes, because when the market is doing well, concentration can look genius. If one stock or one sector keeps going up, people start thinking concentration is confidence. They start believing having everything in one idea makes them bold. Then a crash comes. And suddenly what looked like conviction starts looking like risk. Here's the problem. If all your money is sitting in one stock, one theme, one industry, one hype play, one crypto bet, one AI story, one whatever, then a crash hits you much harder. Financially, yes, but also emotionally. Because now your future feels tied to one thing. And if that one thing gets crushed, your confidence gets crushed with it. That is why diversification matters so much. Diversification does not mean you will not lose money in a crash. You probably still will, but diversification can help stop one bad decision from becoming total destruction. It spreads risk. It lowers the chance that one single blow takes you out. Think of diversification like a seatbelt. It does not stop the accident from happening, but it can stop the accident from ruining your life. And this is where people need to be honest with themselves. If your portfolio is basically a collection of hype, hope, and vibes, then a crash is going to expose that brutally. But if your portfolio is diversified, broad funds, different sectors, maybe different geographies depending on your strategy, a structure you actually understand, then you are more likely to survive the storm without losing your mind. And survival matters. A lot of investing is not just about returns. It is about staying in the game long enough for compounding to actually work. And you cannot stay in the game if one crash emotionally destroys you. So during a crash, do not just ask, what is cheap? Ask, am I diversified enough that one bad call does not wreck my whole future? That is a much smarter question, because diversified investing may feel boring in good times, but in bad times, boring suddenly looks beautiful. Now, once prices start falling, a weird thing happens. Everything suddenly looks tempting. Stuff that you ignored at higher prices now starts looking cheap. And that word, cheap, gets people into trouble. Because cheap and good are not the same thing. Something can fall 50% and still be a terrible investment. Something can get cut in half and still deserve to go lower. So during a market crash, do not just ask, what is down a lot? Ask a better question. What do I actually understand, and what would I still be comfortable holding later? Because if you buy something in a crash and it falls another 20%, you need conviction to stay calm. And conviction usually comes from understanding, not from hype, not from somebody else's confidence, not from random people online shouting that something is the opportunity of a lifetime. If you do not understand what you bought, then every drop will scare you more. And when fear goes up, bad decisions become more likely. That is why simplicity matters. Broad index funds, solid companies, things that fit your long-term plan, things you can explain in plain language. If you cannot explain to a 10-year-old what you are buying and why, maybe you should slow down. A crash is not the time to get more reckless. It is the time to get more selective. And another truth people need to hear is this. You do not need to catch every opportunity. You do not need to buy every dip. You do not need to chase every deal. Missing some opportunities is normal. Buying things you do not understand just because they are down is how people turn a bad market into a worse personal mistake. So keep it simple. Stay in your lane. Buy what makes sense. Because clarity is underrated, and during a crash, clarity can save you from a lot of nonsense. There is one more thing people miss, and it is important. A crash does not just test your portfolio, it tests your behavior. That is why two people can live through the exact same market crash and get very different outcomes. One person panics, sells, jumps in and out, chases noise, and ends up exhausted and behind. Another person protects their real life, keeps some liquidity, buys slowly if they can, stays diversified, and sticks to a plan. Same crash, different behavior, different result, and that is why I keep coming back to process. Because in investing, a perfect prediction is rare. But a solid process, that is something you can actually control. You cannot control headlines. You cannot control interest rates. You cannot control whether the market bottoms next week or next month, but you can control whether you panic. You can control whether you are diversified. You can control whether you use emergency money recklessly. You can control whether you chase hype or stay disciplined. That is where your power actually is. So if you are in the middle of a market crash right now, or if one happens in the future, here is what you should remember. First, protect your real life. If your finances are unstable, fix that first. Second, keep some liquidity if possible, so you are not caught completely empty-handed. Third, if you do buy in stages instead of trying to nail the perfect bottom. Fourth, stay diversified, because diversification will not remove pain, but it can stop one mistake from becoming a disaster. And fifth, only buy things you actually understand and would still want to hold later. That is the framework. Not hype, not panic, not fake confidence, just a process. And honestly, that is what most people need during a crash. Not another dramatic headline, not another screaming thumbnail, not another person pretending they know exactly what happens next. Just a calm process they can return to when everything feels noisy. And one last time, I am not a financial advisor, and this is not personal financial advice. I am simply sharing a practical way to think through a market crash so you can make more grounded decisions for yourself. Because the goal here is not to become fearless overnight. The goal is to become more prepared, more stable, more disciplined, more diversified, and more difficult to destroy when markets get ugly. A crash can feel like the end when you're inside it. But for people with a process, it can also become a moment of clarity. So take a breath, slow down, focus on what you can control, protect your foundation, respect diversification, and remember, you do not need to act like a genius during a crash. You just need to avoid acting like a fool. And that alone can put you way ahead of most people. Thanks for watching.